Peter, we've known each other for a number of years, and you've been an accountant. Tell me just real quickly, you're a CPA, and what firm you're with, and how long you've been in business.
Well, sure. I'm with a partner with Clifton Larson Allen. Clifton Larson Allen is one of the largest accounting firms in the country, although here in Boise our office is relatively small. But we really specialize in dealing with privately held businesses, family-owned businesses, individuals, trust and estates, and that's really been the focus of my practice and my work. I've been doing this for over 25 years now, and I've seen a lot of different kinds of tax situations.
Well, great, and listen, Peter, I really appreciate you spending a few minutes with me to answer some questions that come up all the time relative to real estate and our current economic situation.
Mm-hmm.
First, there's been the Mortgage Debt Relief Act. My understanding is that was extended. Is that correct? And what does that mean?
That is true. That the special provisions that gave relief to individuals that were having debt issues with their personal residence was set to expire at the end of 2012. With this, the American Taxpayer Relief Act that was just passed on January 1st, that Fiscal Cliff Act, it extended that provision through 2013. So we still have another year to take advantage of this, and we'll see what Congress decides to do at the end of this year, if it gets extended further or not.
Well, super. And very, very thankful that was extended. It'll help a lot of people.
Yes.
Now, I run into quite a few common misconceptions for folks that either are experiencing or a foreclosure or a potential short sale. And the thing that seems to come up is they're surprised that there's a possible tax consequence when debt is forgiven from an IRS standpoint. Can you just explain that real briefly?
Sure, and that is a very common misperception. Many people believe that if they negotiate with the bank and get out from under the debt, that they can just walk away. But the tax laws aren't quite so kind. They say that you've really derived an economic benefit from that forgiveness of debt or cancellation of indebtedness, and consequently there's some taxable income that potentially has to be picked up on your tax return.
And that's the same tax consequence if a property goes to foreclosure and or short sale. Is that correct?
That's right. And the tax consequences are very similar, even though the process that you go through is a little bit different.
Okay. But there's a bright side to this and ways around it. The typical scenario that I see with most clients is, the client loses their job or they become underemployed, and they simply can't make the house payments, and they must downsize. And in those situations, the house is usually underwater, and they ultimately decide to short sell. Can you just talk about the tax consequences relative to this legislation as it pertains to their primary residence, regardless of their income or assets?
Sure. Typically what will happen in a foreclosure or a short sale is that the property is sold for less than the amount of the debt that's outstanding, and consequently that difference between the sale price or fair value of the home and the debt that's outstanding is considered cancellation of indebtedness income. Normally that would need to be picked up on your tax return in your taxable income, but this special provision allows that if the debt is related to a qualified principal residence, that you can actually exclude that income and not have to pay tax on it. So it's a great benefit for individuals that are having problems with the debt on their primary residence. There are some restrictions on that. You can't exclude more than $2 million of acquisition debt and some other things that need to be considered. But for most people, this is a great benefit that certainly they'll want to take advantage of. Okay,
and that is great. Now, not every property that's sold is their primary residence. And, we oftentimes run into folks that had purchased an investment property, but they have sort of the same scenario above. They're underemployed, unemployed, property's underwater, maybe negative cash flow. Understanding is that legislation doesn't specifically protect them, but isn't there an insolvency aspect to the IRS code that does provide some protection?
Yes, that's very true. If the property is not a qualified principal residence, then it won't fall under this exclusion we talked about. There really are two other ways to get out from picking up this cancellation of indebtedness income. One is if you're in bankruptcy, and the other is if you are deemed to be insolvent. An insolvency is not always that easy to determine. You really need to look at the fair value of all of your assets, your bank accounts, all your property, your car, your household goods, your retirement account like your IRA, cash value of life insurance. You need to go through the list and identify all of your assets, and then you need to go and identify all of your liabilities, any other loans, credit cards, any other loans that you have outstanding. Things like unpaid taxes or bills can also be included in there. And to the extent that all those liabilities are greater than your total assets, you're considered to be insolvent. And that creates an amount that can be excluded from taxable income. So there is, again, some good benefit there. There are some drawbacks to that, too, that you have to be aware of, and you have to reduce your basis in certain assets and some other provisions. So it's not an extremely simple thing to go through, but it certainly does provide a good benefit for people in financial problems.
But the debt on the, let's say, investment property, the loan on that, would be included as part of your liabilities. Is that correct?
Right. Yes.
Okay. And then the last thing we run into are folks that want to do what we classify as a strategic default, and those would be clients. They have pretty good income, they have assets. They don't really qualify for this insolvency deal. What should they be looking at?
Well, that's a tough question. Usually, someone in that situation where they're looking at some sort of strategic default, it's a pretty particular to their circumstances. You almost have to look at that at a case-by-case basis and do some projections, do some planning to make sure that you're not putting yourself in a bad tax situation, or maybe a better way of putting it is to take advantage of whatever tax breaks you can get. So that's a tough question to answer because it really is on a case-by-case basis.
Okay, so those folks would need to meet with you or their tax professional. Is that correct?
Yeah, I think if you're at that point in your planning, it's time to call in someone that has the experience and can give you some additional guidance on your specific issue.
Well, Peter, I really appreciate your time, and I think we've answered some complex questions that apply to a broad range of people that are and families that are in this situation, and I know that this information will be very valuable to them.
Well, great. It's always a pleasure.